Welcome to the Straits Financial News Recap, your update on the latest market trends and developments. 2025 was a year of adjustment and resilience. While the global economy avoided a severe downturn, persistent challenges such as inflation, geopolitical tensions, and shifting trade dynamics continue to shape investor sentiment. As markets move into 2026, attention turns to the sustainability of growth, the trajectory of monetary policy, and fiscal support from major economies. Looking ahead, coordinated fiscal and monetary policies are expected to remain a key driver of global macroeconomic trends, shaping market sentiment and investment flows worldwide. In 2025, despite a sharp downturn in April triggered by the Trump administration's tariff-related trade war, global markets rebounded strongly and went on to rally. As a result, many countries recorded solid gains in their stock indices. Global stock markets rose sharply in 2025, but structural economic issues and downside risk persist. Market gains, especially in equities, were primarily supported by ample liquidity from fiscal and monetary measures and steady capital inflows. China's fiscal easing aims to support new industries and high-quality production, but insufficient domestic demand means the economy remains heavily reliant on exports to absorb output. Heading into 2026, most major countries are likely to maintain both fiscal and monetary easing due to ongoing economic challenges and the risk of a slowdown. Inflation in the US and Japan is expected, but unlikely to shift global easing policies. The global economy faces a significant risk of insufficient aggregate demand, driven by widening wealth gaps and slower demand growth in emerging markets, which are making the supply-demand imbalance more prominent. China is likely to keep fiscal and monetary policies accommodative in 2026 to stimulate domestic demand, while global stock markets are expected to perform positively for the year. A slowdown in economic growth is not expected to significantly threaten the stock market, as it may encourage more supportive fiscal and monetary policies. However, investors need to monitor low-probability, high-impact risk, such as geopolitical conflicts or financial shocks. Rapid AI adoption could lead to a contraction of the job market. While fiscal stimulus may help, its effectiveness and scale remain uncertain, creating potential social, economic, and market risk. While global stock markets are expected to trend positively in 2026, the risk of a rapidly forming bubble cannot be ruled out, and investors should remain attentive to low-probability but potentially disruptive events. In today's shifting economic conditions, U.S. equities are expected to remain strong, supported by policy tailwinds and steady capital inflows, despite potential divergence among individual stocks. A shares are in a slow bull market, likely trading within a range for now, but dips could be opportunities to accumulate for 2026. The outlook remains constructive in base metals and gold. Ongoing investments in AI, data centers, and energy storage are set to drive demand for key metals like copper, while those with limited supply are likely to see even stronger gains. Follow Straits Financial Group on all our channels to stay ahead of the markets.